Trying to live off dividends with the S&P 500 alone? You'd need a massive upfront investment in millions and 50 years of patience, more time and money than most people can realistically commit. But what if you could speed that up a lot? What if there were a way to hit that same $2,800 a month income goal in less than half the time? In this video, I'm going to show you exactly how to do that, starting with just $10 a day. I'll walk you and John through a custom-built dividend portfolio designed to grow your income faster and more efficiently than the S&P 500 ever could. At the end, I'll break down a side-by-side comparison so you can see for yourself why this strategy gets you to the finish line years, in fact, 30 years faster. But first, let's set the stage. If your goal is to earn $2,800 a month from dividends, that adds up to $33,600 a year. Now here's where it gets interesting. How much money do you need to generate that kind of income? That's where dividend yield comes in. The dividend yield is simply the percentage of a company's stock price that it pays out annually in dividends. So if a stock is worth $100 and pays $3 in dividends per year, that's a 3% yield. Easy, right? Now let's do some math. If your portfolio has a 3% dividend yield, you'd need about $1.12 million to make $33,600 annually. If you bump that yield up to 4%, the required portfolio drops to $840,000. And at 5%, you'd only need $672,000. That's a big difference, and it shows why optimizing for yield is so important when income is your main goal. But yield isn't the whole story. There's a secret weapon in dividend investing that most people overlook: dividend reinvestment. When you take the dividends you receive and use them to buy more shares, you increase your ownership in those companies. That means next time they pay dividends, you get even more, and so the compounding begins. Let me explain by using a simple example. Let's say you invest $10,000 into a stock priced at $20 a share. That'll give you 500 shares. Now, this stock pays a 5% dividend, which means in year one you're getting $500 in dividends. But instead of spending that $500 on, say, a weekend getaway or some gadgets, you decide instead to reinvest it. You use that money to buy more shares at $20 each, which gives you 25 extra shares, which means you now own 525 shares. Now fast forward to year two. Those 525 shares pay you a dividend as well, still 5%. This time you get $525. Not a huge jump, but it's more than the last payment. You reinvest that again. That $525 buys you about 26 more shares. Add that to what you already have, and you're up to 551 shares. Year three rolls in. Now you're earning dividends on 551 shares. That pulls in about $551.25. Reinvest that and you're buying another 27 shares or so. Your total share count climbs to 579 shares. So let's pause for a sec. You started with 500 shares. 3 years later, you've got nearly 579, all without adding a single extra dime out of pocket. That's what compounding looks like in real life. It doesn't feel dramatic at first, but those tiny increases, they start to snowball. Each year, your dividends buy more shares earn more dividends, and that's just 3 years. Now imagine what happens when you stretch that over 10, 15, 20 years. Now the big question is, can the S&P 500 get you to that $2,800 a month milestone? Let's talk about it. You've probably heard about SPY, the SPDR S&P 500 ETF. It's like the gold standard of long-term investing, and for good reason. It's packed with 500 of the biggest, most rock-solid companies in the U.S. It's delivered solid returns year after year. It's reliable, it's safe, it's smart. But if you're trying to live off your investments, specifically through dividends, SPY might not be your best bet. Let me explain why. The average dividend yield on the S&P 500 is about 2.5%, and that's if it pays well. That means if you invest $100, you're getting around $2.50 in annual dividends. It's better than nothing, sure, but if you're trying to build up income you can actually use, like a legit $2,800 per month, it's gonna take a long time, and I do mean long. Let's break it down using this chart. Say you're consistently investing $10 a day. That's $3,650 by the end of year 1. You reinvest everything. You let the compounding do its thing. By year 10, your portfolio will grow to around $75,000 in SPY. Keep going, and by year 20, it'll reach $288,000. By year 30, you'll be at $891,000. Fast forward to year 40, and you'd be sitting on $2.55 million. And if you keep at it for 51 years, that number will be around $7.09 million. Those early years, the dividend income is barely noticeable, but over time, as your portfolio grows, so does the income. By year 51, you would finally be earning around $34,900 a year in dividends. That's roughly $2,908 a month, just over the $2,800 target we've been aiming for. So yes, this strategy works. The numbers add up. But here's the reality check. It took you more than 50 years to get there. So why does it take the S&P 500 so long to deliver real income? Well, here's the thing. Most of its return doesn't come from dividends. It comes from the stock prices going up over time. That's called price appreciation. And while that's great for growing your net worth on paper, it doesn't do much for putting actual cash in your pocket along the way. In other words, your portfolio might be worth a lot someday, but it's not paying you enough to quit your job, cover your bills, or buy back your time anytime soon. And this is where a lot of investors get stuck. They hear index funds and S&P 500 and think it's the one-size-fits-all answer. So they follow the crowd, they invest, they wait, they trust the process. But when it comes down to building actual income, the kind you can live on month to month, it is a painfully slow road. Smart strategy? Sure. Fast path to freedom? Not even close. And for most people, 50 years is just too long to wait, which brings us to a better question. What if you didn't have to wait so long? What if you could hit that $2,800 a month goal not in 5 decades, but in under 20 years? To make it work, you need a portfolio with the right dividend stocks. I'll show you how a tailored dividend portfolio can optimize this process, reducing the amount of time and capital needed to reach $2,800 per month. In the end, I'll show you how this portfolio will get you the fastest track to $2,800 per month. In fact, it'll reach that target in just 20 years, which is less than half the time of an S&P 500 ETF. Now, when it comes to building a dividend portfolio that works, not all dividend-paying stocks are created equal. It's not just about grabbing the highest yield you can find. What you really want is balance. You want income, sure, but you want reliable income. Income that grows, income you can count on. And to get that, there are a few key things you should be looking for. First, there's dividend yield. This tells you how much you're earning on each dollar you invest. It's important, but it's only one part of the story. Chasing high yields alone can be a trap. Some stocks pay extremely high dividends because their price is falling or their business model is unstable, and that's a red flag. If a company can't support its payout, the dividend might get slashed, and that income stream could disappear overnight. That's why dividend growth is such a powerful signal. When a company consistently raises its dividend year after year, it's often a sign of strong earnings, responsible management, and long-term profitability. A company that grows its dividend at 10% or more each year is compounding your income in a way that's just as powerful as reinvestment. Next, I look at payout ratio. That's the percentage of earnings a company uses to pay dividends. A healthy range is usually under 60%. It shows the company isn't stretching too far to reward shareholders and still has money to reinvest in its own growth. You also want to think about consistency. Has the company paid and increased its dividend through different market cycles? If they've kept paying during recessions or downturns, that's a strong sign they'll continue to do so in the future. And finally, there's diversification. A dividend portfolio shouldn't be overloaded with companies from just one industry. Spread your investments across different sectors like financials, healthcare, consumer staples, and even real estate to reduce risk and improve stability. Certain sectors, like REITs, are especially attractive because they're required by law to return a large portion of their profits as dividends, making them natural income generators. When you put all of that together, good yield, strong growth, smart payout ratios, proven consistency, and solid diversification, you're no longer guessing. You're building a machine, one that's designed to grow your income year after year and get you to that $2,800 per month goal faster than most people think is even possible. So now let's put the strategy into action. What does a real-world dividend portfolio look like when it's designed for maximum growth, strong income, and long-term reliability? Well, here's a portfolio that's been built using all of those principles. It starts with the Schwab US Dividend Equity ETF with the ticker symbol SCHD. This acts as the core foundation of the portfolio. It's got wide diversification, a 3.8% dividend yield, and it's laser-focused on quality companies with consistent cash flow. It doesn't just give you stability, it gives you performance too, with an average annual dividend growth of 10.77% and a solid 7.87% average share price each year. Then there's the Federal Agricultural Mortgage Corporation with the ticker symbol AGM. While it might not make headlines, AGM delivers big where it counts. Its income stream is steady, and its business model is built for durability, with a financial performance that continues to push both dividends and value higher over time. Its numbers are incredible: a 3.46% dividend yield, a massive 25.47% average dividend growth rate, and 20.69% annual share price appreciation. Next is Interparfums with the ticker IPAR, which brings a different kind of strength. As a global fragrance company, it combines niche branding with dependable financial results. It's the kind of company that might fly under the radar but continues to grow year after year through smart expansion and reliable profits. It shows a 2.41% dividend yield, a strong 20.26% dividend growth rate, and a 16.08% annual share price appreciation. Next up is Morgan Stanley with the ticker symbol MS, adding heavyweight credibility. As a major player in global finance, it has the reach, the reputation, and the results. Its dividend growth speaks for itself, 23.45% over 10 years, alongside a 2.86% dividend yield and 13.41% annual share price appreciation. It's a steady and powerful contributor to the portfolio's income and growth. And finally, there's AbbVie with the ticker symbol ABBV. Healthcare is always in demand, and this company is a dividend powerhouse. It has a 3.51% dividend yield, a 12.86% dividend growth rate, and 10.38% annual price appreciation. It offers both income security and defensive strength, even in turbulent markets. Next, let's see how to find your portfolio metrics, starting with the dividend yield, and it's fairly simple. First, you take the current dividend yield of each stock in the portfolio: SCHD at 3.8%, AGM at 3.46%, IPAR at 2.41%, Morgan Stanley at 2.86%, and AbbVie at 3.51%. You add all these yields together, which gives you a total of 16.04%. Then, since you have 5 stocks, you divide that number by 5. The result is 3.21%, and that is your average portfolio dividend yield. You can apply the exact same method to calculate the portfolio's average dividend growth rate and share price appreciation. So your final portfolio averages are 3.21% dividend yield, 18.56% dividend growth, and 13.69% share price appreciation. Now that you've seen the portfolio, the big question is, how quickly does it reach your income goal? Well, let's say you start with nothing but commit to investing $10 a day. By the end of year 1, you would have invested $3,650. This sets the stage for future growth. By year 5, your portfolio will be valued at $25,797. By year 10, the portfolio value will reach $85,768. Fast forward to year 15, and it'll be at $234,943. And finally, by year 20, the portfolio value would hit $634,925, and your annual dividend income would hit $41,126. That's about $3,427 a month, completely from dividends. The $2,800 per month income goal achieved. Now here's the part that really puts this strategy into perspective. Let's stack it up side by side against the traditional path, the S&P 500. Everyone knows the S&P 500. It's got a reputation, it's diversified, it's delivered steady returns for decades, and honestly, if your goal is to build long-term wealth slowly, it is still a solid option. But if your goal is income, monthly income, that's where it starts to fall behind. With an average dividend yield of just 2.5%, SPY simply doesn't pay out much. Even if you're religiously reinvesting every dividend and contributing like clockwork, it takes a long time to build serious income from it. In fact, as we mentioned earlier, you'd need to stick with it for 51 years to reach $2,800 per month in dividends. Now compare that with what this tailored dividend strategy delivers. To reach the same goal, or in fact a better one, it took only 20 years. It reached a better target in less than half the time. This dramatic reduction in time comes from how the portfolio is built, intentionally, with speed in mind. Higher starting yields, fast-growing dividends from names like AGM and IPAR, and steady reinvestment all work together to create an accelerating compounding effect. Instead of relying mostly on price gains like the S&P 500, this portfolio grows income from the inside out. A 3.21% starting yield and 18.56% dividend growth mean your income multiplies faster with every passing year. Reinvested dividends buy more shares, which pay even more dividends, and the cycle snowballs. That is why this strategy reached the goal in 20 years, not 50. Same goal, less than half the time. Want to know how to turn a $20 weekly investment into a portfolio that pays over $70,000 in monthly dividend income? Click the video on the screen.